Here's why the New Year's tax deadline matters right now. As institutional portfolios recalibrate amid year-end reporting cycles, the intersection of fiscal policy and asset allocation is creating ripple effects across markets. Today's data reveals a pivotal shift. Gold surged 0.83% to $4,532.58, while the S&P 500 edged higher, signaling resilience in equities. Yet, the Dow Jones Industrial Average faces unique pressures tied to the tax deadline, a window where institutional investors may adjust positions ahead of mandatory filings. This is a mere coincidence. The tax deadline acts as a catalyst for strategic rebalancing. With retirement accounts and pension funds required to report holdings, there's heightened scrutiny on volatile assets like gold and silver. Traders are already seeing increased volume in precious metals, reflecting both hedge fund rotation and retail investor behavior. Meanwhile, the Dow's mixed performance hints at sector-specific vulnerabilities, particularly in industries sensitive to tax liabilities. Broader macro forces amplify this dynamic. Global inflation remains elevated, keeping real interest rates in check. Yet the Federal Reserve's dovish stance has created a paradox. Lower borrowing costs boost equities, but also weaken the dollar's appeal. This duality explains why gold, historically a hedge against currency devaluation, continues its bullish trajectory despite mixed sentiment and risk on assets like Bitcoin. For traders, the key lies in timing. The tax-driven volatility creates short-term opportunities, especially near key support levels for gold and the Dow. We're watching for a potential pullback in commodities as institutional flows pivot towards safer havens. However, the S&P's steady climb suggests broader confidence in equities, particularly sectors benefiting from fiscal stimulus. Positioning now requires balancing exposure between defensive assets and growth-oriented stocks. If this analysis was valuable, subscribe for more institutional insights. Link in bio.